What if I told you that most investors are overpaying anywhere from $8,000 to $11,000 on their investment property mortgages? By the end of this video, you'll learn exactly how to avoid this costly mistake and discover creative financing strategies that most lenders save for themselves. Hi, I'm David Zai, and I've helped hundreds of investors build wealth through real estate. Stay with me until the end for step-by-step guide to saving thousands on your next investment property purchase or refinance. Before we dive into strategies, let's take a look at the current market and what's happening and shaping the investment landscape in 2025. Inflation is obviously at the top of all of our minds, and the impact on investment properties is pretty big. Although too much inflation is bad for everyone, there is a way to leverage mid to high inflation rates to your advantage when you become a home investor. Inflation will persist into 2025 and beyond, and the cost of building supplies is expected to continue rising. This means property values will likely keep increasing, making real estate a solid hedge against inflation. Tariffs on imported goods are adding further pressure on construction costs, limiting the supply of new homes. This scarcity drives up demand and prices for existing properties. The interest rates, trends, and projections, here's what most lenders won't tell you. Higher interest rates could be your secret advantage. While rising rates discourage some homeowners from selling their low-rate properties, they also put financial strains on others. Inflation and increasing debt levels may force some owners to sell, creating buying opportunities for savvy investors. So staying ready with financial options tailored for investment properties can position you to capitalize on these deals as they arise. So you want to know how successful investors qualify? They understand the dynamics of the rental market. The rental market remains strong, but the trend of rising rates have forced multiple tenants to share single-family homes or multifamily units, combining households is growing, and this creates opportunities and challenges. To mitigate the risk, consider higher security deposits for properties with pets or multiple tenants, slightly increased rental rates to offset potential repair costs, and rental demand is expected to stay high as home ownership becomes less and less accessible due to rising rates and prices. With the property appreciation in the forecast, the secret to saving $11,000 is thinking long-term. While I'm not an economist, one glance at property values on real estate sites will show you that real estate appreciates significantly over time. For mid to long-term investors, holding properties for 5 or more years, history shows that you'll be very happy with your decision. Rising material costs and constrained new construction further limits housing supply, boosting demand and appreciation for existing properties. Why does this matter, you may ask? Understanding market conditions isn't just about staying informed. It's about using this knowledge to make strategic decisions. The combination of inflation, interest rate, and rental demand and appreciation creates a unique opportunities for investors who are prepared. In the next section, I'll show you how to finance your investment properties creatively and strategically, leveraging loan options that can save you thousands and set you up for long-term success. Understanding the current investment property landscape is key to making informed decisions. Here's a look at lending environment, market opportunities, risk factors, and regional considerations for 2025. The current lending environment is a competitive lending environment, and not every lender offers the diverse programs you'll need to succeed as an investor. So we really have to think about this, right? When you make the offer, fine, they take the offer, and then you go through the underwriting process, you get the appraisal, you get the title work. If issues arise, such as a low appraisal, or issues arise, such as not enough money to close, or issues arise because the lender told you that they could do the loan and they can't, then that's going to be an issue. Here's what most lenders won't tell you. Some of the most flexible financing options like DSCR loans or debt service coverage ratio, bank statement loans, asset depletion loans, or no ratio loans aren't available through all lenders. So whether you're buying, refinancing, fixing, flipping, or holding, having access to these creative financing tools can be a big difference between success and missed opportunities. To thrive as an investor, you must always be looking for opportunities. Don't be an undercover investor. Let people know that you're in the market. Turn them into bird dogs who scout properties for you. Even non-investors may come across quality investments, and you'd be surprised where your next lead may come from. Track real estate listings religiously. Subscribe to foreclosure agents, network with property wholesalers, and watch for distressed sales tied to the 4 Ds: debt, diamond, diapers, and divorce. By leveraging these strategies, you can uncover deals before they hit the broader market. Real estate investing isn't without its risk, but the reward can far outweigh them. The frustration of managing properties is often balanced by someone else paying down your mortgage while your equity builds over time. The key is knowing your limits. Are you prepared to handle repairs, tenant turnover, or unexpected expenses? Real estate success requires persistence and planning. Finding a region that is close to where you live or in an area where you like to visit is key. So let's hone in on location, location, location. Research is critical when choosing where to invest. Analyze job availability, population trends, and housing supply demands in the area. Determine if the property will yield positive cash flow or if you're comfortable with a short-term loss for long-term gains. Some markets favor city living, while others thrive in suburban areas. Choose a region that aligns with your goals. Now that you've chosen your region, let's talk about the pre-qualification preparation that you need to know. Getting pre-qualified is a crucial step in your investment journey, and here's what you'll need to provide. The documentation. Tax returns for the last 2 years. Is required for all full doc loans. These allow your loan officers to assess your income and identify potential savings through programs like Fannie, Freddie, or the non-conforming loans like we're talking about. For self-employed, you need to provide your business tax returns. Providing these upfront will help the loan officer determine your true qualifying income if we're using income to qualify. Bank statements for 2 months to 12 months are essential for both full doc and non-conforming loans, such as your asset depletion and bank statement loans. Bank statements provide an insight into your monthly cash flow. Asset documentation or other asset documentation includes stocks, bonds, mutual funds, 401ks, and even trust accounts. These can strengthen your application for both the full doc and non-conforming loans. Current lease agreements. If you have an existing rental property, lease agreements can help you qualify by applying projected rental income or current rental income from a new, departing, or current property that you're using for investments. Property management history is also huge, especially on non-conforming loans. A solid track record of managing properties can open doors to non-conforming loan options and make exceptions possible for unique properties. So now let's dive into financial preparation and credit score requirements. For the best terms, aim for a minimum credit score of 680. Some lenders, particularly wholesale lenders like myself, may go as low as 580, but be aware that the lower scores will result in a higher rate and fewer loan options, as well as property options. Your source of down payment is very important too. For conventional loans, for investment properties, they typically require that you use your own funds. But for non-conforming loans, they may allow for gift funds or borrowed funds as part of your down payment and closing costs. Reserve requirements are typically going to be required for almost every loan you think about. However, most lenders do prefer at least 2 to 3 months of reserves for large investment properties, and you may need 6 to 12 months depending on the overall qualification for all the other properties that you own. Debt to income ratio consideration is typically only going to be relevant for conventional loans, whereas non-conforming loans may not weigh that debt to income ratio as heavily or may consider it all, or as in the case of a DSCR loan, not required at all. Here are some credit optimization strategies, because the higher your credit score, the less you're going to pay for the mortgage and the cost. Use annualcreditreport.com to review your credit and report any inaccuracies and dispute it right then and there. Pay down all of your credit card balances below 50% utilization, ideally below 30%, at least 30 days before applying. Avoid any 30-day late payments on any of your accounts on your credit report, because delinquencies during the loan application process could be the kiss of death. Remember, under the Fair Credit Reporting Act, creditors can take up to 60 days to report updates, so timing is critical. Preparing properly and understanding the investment property landscape can save you thousands of dollars in countless hours. Whether you're aiming for the best loan terms, covering hidden opportunities, or optimizing your credit, every step brings you closer to achieving your investment goals. When finding that investment property, choosing the right lending channel can save you significant money. Let's explore why wholesale lending is often the smarter choice. Based on 2021 HMDA data, borrowers who choose wholesale lenders over retail lenders save between $8,000 and $11,000 over the life of the loan. Wholesale lenders not only offer more options, but also provide lower costs due to their streamlined structure. How does wholesale lending work? Think of wholesale lending as a customizable approach to financing. Retail lenders typically operate with layers of management, loan officers, managers, in-house underwriters, and closers. While this may sound convenient, high production can overwhelm their operations, leading to delays and often higher costs due to lock extension fees. Wholesale lenders, on the other hand, often require an experienced mortgage broker that has the ability to shop across multiple lenders. Brokers communicate directly with account executives and operation managers to compare turn times, pricing, and product availability. This flexibility ensures that you get the best deal and the speed needed to close on time. Another added benefit of working with wholesale lenders is one credit pool. Unlike shopping on your own, where you call one lender and get your credit pulled and call another one and get one pulled, as a wholesale mortgage broker, we take that one credit report and we shop it around to different lenders and we choose the option that fits you best. So we do all the shopping based on that single credit inquiry. Then we tailor your options. Wholesale brokers can align you with the best lenders for your specific needs, whether it's pricing, turn time, or unique programs. Here are the common misconceptions, and let's start with the biggest one. National call center versus the local lender. Who's going to really give you the best deal, or the wholesale lender, right? Not all national lenders are call centers, and not all all call centers are local lenders or vice versa. So they're all different. But many call centers do operate with limited hours, virtual assistants, and solicitors. The service level can be inconsistent. Your local lender may not always be available, but they also may work for retail. So are you willing to pay that little extra to work with that local lender to walk into their office? Or would you rather save $8,000 to $11,000, which can truly buy you a used car, and work with a wholesale lender who can shop it with multiple places? If one underwriter denies it, we can take it to another underwriter and hopefully get the loan approved. When we're comparing the local versus wholesale, working with your local lender doesn't guarantee a smoother or faster transaction. Do your research by checking your local loan officer's NMLS number and reading online reviews. Transparency and expertise matter far more than proximity. Do you want to know how successful investors who have no income can qualify for that investment property or cash out refinance to buy additional investment properties? Well, they often use DSCR loans, a powerful tool for financing investment properties. A DSCR loan, which is debt service coverage ratio, is designed for real estate investors, and instead of verifying personal income, it focuses on the cash flow of the property itself. Countless benefits to a DSCR loan, but we'll start with a couple. No income verification required. You don't need to provide pay stubs, W-2s, or tax returns. Simple approvals. Qualification is based on the property ability to generate rental income and not your personal income. Property cash flow analysis. The DSCR measures the property's net operating income, NOI, against its debt obligations. So, for example, if a property's NOI is $2,000 and the monthly debt payment is $1,500, then the debt-to-income ratio, or DSCR, is 1.33%. A higher DSCR indicates better cash flow. The minimum DSCR requirement for most lenders is going to be 1-to-1. However, some wholesale lenders may be able to offer you better terms or better ratios as low as no ratio qualification. And obviously, with the higher risk is going to turn into a little higher rate and cost on the loan. Rates for DSCR may be slightly higher than your traditional loan, but the ease of qualification and focus on cash flow make them invaluable for investors looking to expand their portfolio quickly. The next thing is portfolio lending. The benefits of portfolio lending is portfolio lendings are loans that are held by lenders instead of being sold on the secondary market, offering more flexibility in qualifying criteria. So these loans offer flexible terms and are ideal for borrowers with unique circumstances, such as self-employed individuals, investors with multiple properties, or those with lower credit scores. When you're looking to do multiple property financing, portfolios allow you to finance multiple properties under one loan, simplifying management and potentially lowering costs. They also offer cross-collateralization options. With cross-collateralization, you can use equity from one property to secure financing for another. This is a great strategy for expanding your portfolio without depleting your cash reserves. Now that we talked about all the good stuff, let's talk about the exit strategy. Portfolio loans often come with shorter terms or balloon payments. So once it gets to a certain term, they're going to say, hey, you need to refinance this loan, pay it off, or you're going to owe me a large amount. It's essential to have an exit strategy, whether it's refinancing, selling, or converting to a traditional financing option. When traditional loans aren't the right fit, alternative funding strategies can help you achieve your investment goals, whether it be for a purchase or a refinance. Private money options are really good. Private money lenders can provide fast, flexible financing for unique opportunities, often with fewer documentation requirements. If all of those fail, there's hard money. I had an investor reach out to me recently, and we've done multiple loans for this investor. This investor came to us and they needed $1 million. I mean, they lived in a castle, right? You know, they had tons of investment properties, but we've all heard the saying, more money, more problems, right? So this guy really needed $1 million. We approached it in many different ways. We looked at the DSCR, we looked at the bank statement, we looked at portfolio products. None of them really wanted to touch this guy. He was really behind on his mortgage. Then we moved on to the private money option, right? The private money option had an option for him, but there were some unique circumstances that he didn't want to go down. And then finally, he was like, I really need this money fast. And that's where we found the hard money for him. And with that, there were certain criteria saying that, hey, we're gonna let you borrow this money for a year, but within a year, you have to sell your property. And every month that the property doesn't sell, you would have to drop it by this much, this percentage. And with those terms, he agreed to it. He got the funding that he needed to maintain all of his properties, and we've closed on the loan. With that being said, hopefully that $1 million that he took out would be used to pay down debt, get everything in order, and then we can refinance him later on into way more favorable terms. So working with that wholesale mortgage lender opens up all these different options for you. Let's go to more traditional options now. Home equity utilization. Leveraging the equity in your existing properties with a HELOC or home equity line of credit, or even a cash out refinance, does provide a very good option. This can provide funds needed for down payment or renovations, or even funds to purchase another property. If you don't have the money, you may want to consider partnering up with someone. Partnering with others allow you to pool resources, split risk, and tackle larger investments. Ensure your partnership agreements are clearly defined to avoid any misunderstandings. What I'm starting to see more and more now, and in a lot of cases, is seller financing. In some cases, sellers may be willing to finance part or all of the property purchase. This can really reduce all the upfront costs and provide flexible repayment options. Real estate investing requires the right financing strategy, whether you're leveraging the savings of wholesale lending, the flexibility of DSCR loans, or the creative potential of portfolio and alternative funding strategies. Knowing your options is crucial. The secret to saving thousands and building wealth lies in understanding these tools and working with an experienced wholesale professional who can guide you every step of the way. Coming up next, we'll explore real-world case studies of how investors like you are using these strategies to grow their portfolio. So don't forget to like this video, subscribe, and visit my website, David Zion Mortgage Guy, for more pro tips, tools, and personalized guidance. If you'd like to speak to me now, click the link below. Let's talk about the core team members, because building your core team is one of the most critical steps in a successful real estate investing environment. These professionals help you navigate the process, avoid costly mistakes, and maximize your investment potential. Your number one team member is your lender. And we've already got you covered on the importance of working with someone who understands wholesale lending, investment property financing, and creative loan solutions. Let's move on to the next key player, your real estate agent. Their expertise can make or break your investment strategy. It's not just about hiring someone who sells homes. It's about finding someone who knows how to spot a great investment property. Your investment property focus should be to talk to the prospective agents about their experience with investment properties, research their knowledge of rental markets, cap rates, and ROI analysis. Make sure they're giving you all of their market analysis capabilities by asking your agent how they stayed informed about market trends, rental demands, and appreciation forecasts. Make sure they have really good negotiation skills, because here's what most people don't do. Check the agent's track records by comparing listing prices to actual sales prices on properties that they've closed. This data is often available online and tells you how well they negotiate. For property management connections, they should be well connected there too, because this is arguably the most important aspect. The right property manager can save you time, money, stress, and multiple headaches. During the interview, ask the property manager how many properties they handle per manager. Multitasking is key, but you don't want someone who's stretched so thin that your property doesn't get the attention it deserves. A thorough property inspection can save you thousands or tens of thousands in unforeseen repair costs. So let me share a personal story. Many years ago, I purchased a house and I thought I had done everything right. I had all the inspections done, everything seemed fine, and I closed confidently. A year and a half later, during a routine termite and moisture inspection, the termite inspector discovered that half of the house wasn't being supported on the cinder blocks. It ended costing me $18,000 to fix, and this was years ago. So adjusted for today's cost, and it would be likely closer to $45,000. So with my story, it's really important to choose an investor with investment property experience who knows what to look for, especially in areas prone to structural issues. Ensure that they provide a detailed report that includes photos, cost estimate, and repair priorities. Don't rush the process. Choosing the right inspector can save you from expensive surprises later. Insurance is an essential part of protecting your investment, and here's how to make sure you're getting the best coverage. Shop around with just brokers. Just as you shop for a mortgage, you should shop for your insurance. Work with an insurance broker who can pull quotes from multiple providers with just one credit pull. If you're buying in areas that are prone to hurricanes, floods, or other natural disasters, this is the time that I would say you need to shop with a large brand name insurers as well, because sometimes they offer more competitive rates due to their ability to manage risk at scale. The next thing that's really important, especially if you're buying in high-risk areas, is make sure you customize your coverage, because it's not a one-size-fits-all. Make sure your policy covers rental-related risk, including liability coverage for tenants. Let's round out your team with these crucial professionals. Property manager, screen for experience, responsiveness, and tenant placement strategies. A handyman network. A reliable handyman is invaluable for quick, cost-effective repairs. Real estate attorneys. They'll ensure your contract and agreements protect your interest. Tax professionals. Their guidance on deductions, depreciation, and other tax strategies can significantly boost your ROI or return on investment. Termite and moisture inspectors are especially important in humid regions. These specialists help you avoid costly structural repairs. Here's how to set yourself up for success during the purchase phase. Market research. Identify high demand areas with strong rental potential. Evaluate ROI, appreciation potential, and maintenance costs. Determine if the property will generate positive cash flow, secure your loan to strengthen your offer, ensure your team is ready to act quickly when you find the right property, and do your due diligence. So during the due diligence period, these inspections should not be taken lightly. The first one is going to be your property inspection. You need to conduct a thorough inspection to identify any major issues. The second thing is going to be your title search. Confirm the property's ownership history is clear. Insurance quotes, weighing out the insurance broker versus the national company to find the best rates and coverages. Property managed setup, plan for tenant placement and ongoing maintenance. Renovation estimates, get detailed quotes up front to understand the repair and upgrade cost as well as time frame. And here's what happens from contract to keys. Purchase agreement, you shop for a house, you found the house that you like, you write up the contract and it's finalized. After that, you're gonna go straight into loan processing. You're gonna submit all of your required documentation depending on the type of loan that you're getting. From then, send everything off to the underwriter. They're like the judge on the loan. The lender kind of evaluates your financials and the property to ensure that it's compliant and it meets all the loan terms. Closing coordination. This is the team that ensures that all the parties are aligned for a smooth closing day. And then finally, post-closing setup. Finalize utilities, property management, the walkthrough, tenant onboarding. Cutting closing cost is a smart way to increase your ROI. Seller concessions. Negotiate with the seller to cover some or all of your closing costs. The timing consideration is also very important. Align your closing date to minimize overlaps with other expenses. Rate optimization, locking in with the best rate for your financing, and also checking up on it right before closing is really important because there may be a rate renegotiation that is available, or they can move lenders and get it closed quickly. Term selection is also very important. Choosing the loan term that fits your cash flow strategy is really important. So if your strategy is to pay off the house as fast as possible, go with that shorter term, 15, 10 years. If your strategy is to get the most cash flow as possible, choose those longer terms. The road to successful real estate investing starts with building the right team and choosing the right financing strategy. Whether you're a first-time investor or looking to expand your portfolio, my team and I are here to help. Click on the link below to chat with us or visit my website, davidseyemortgageguy.com, for tools like mortgage calculator, insider tips, and personalized guidance. Don't forget to like this video, subscribe, and turn on the notification for more expert advice on building wealth through real estate. And let's make your investment dreams a reality, whether it be a purchase or a refinance.